Oh, I got a few more people coming in.
Okay.
Okay. All right. So, yeah, I'll just mute people as they come in. And I'm lucky to have Michael here with us today, presenting about reverse mortgages, myths and facts. Let me get this screen set up and take it away, Michael.
Hi, so my name is Michael Perlman from Silverfin Capital. I am a mortgage broker. I specialize in every loan, including reverse mortgages. So I'm here today to kind of go over a lot of misnomers, the myths versus facts of reverse mortgage. There's a lot of kind of bad publicity and bad light put on them, but they're actually a great tool and a great product, if it's right for you, of course. So that's something that I would do a consultation with your client or yourself, and determine if it's the right loan for you. And if not, maybe put you in a different type of product. So first, I don't know if everybody knows about reverse mortgages. Next slide, please. So just to give a quick little rundown of the reverse mortgage. Um, so the reverse mortgage, so you can call what's called like a forward mortgage, which is like regular loans that we do, a conventional loan, where you're paying a payment each month. Interest is accruing, which is the same thing as a reverse mortgage. The difference with the reverse is you don't have to make a payment. In fact, you're being provided your equity each month. So that's kind of the main difference there. So reverse mortgages are particularly for the elderly-ish, 62 years and older. I'm not going to say that's elderly, but on your latter years of life. So you have to be at least 62 years or older to qualify for the HECM, which is the home equity conversion mortgage. That's the most common type of reverse mortgage. And the older you are, the more money you may be eligible for. So these loans are actually backed by FHA and HUD, and which is the Federal Housing Administration and the Department of Housing and Urban Development. It gives the borrower with strong consumer protections and guidelines that lenders have to follow. So the lenders have to go off of these guidelines. They can't make up their own rodeo rules or anything like that. When it comes to how much you can borrow, a lot of people think you can get 60, 70% of the home's value. Typically with reverse mortgages, at most, you're going to get 40 to 45%. The older you are, the more you qualify for. Um, you can do a purchase or a refinance. So let's say you want to downsize, you have a very large home, you don't need it anymore. You can sell the home, take that equity, and actually get a purchase reverse mortgage so you can buy a new home and not have to make any payments on it. It's a great tool for that. Or you can do the regular refinance where you access equity in the home, before pass away, basically. I know it's a little doom and gloom, but this is what the mortgages are for. They're for your latter years when you may not have as much residual income, and you want to enjoy yourself. When you want to access some of the equity, whether it's for you or for your descendants, your heirs. So no payments are made, although payments are allowed. So with the reverse mortgage, typically you'll get a payment either each month or you can have some lump sums given to you. There are limits to how much you can get over a certain period of time, but no payments are made. Again, like I said, you are allowed to make payments. Qualifying factors are age, credit history, and income. Now, your credit score doesn't matter as much as your credit history, which would be, like payments made on time, whether you have any late payments, and then your income as well. Income isn't as important either, but typically you have to have enough income to at least support the taxes and insurance of the property. If you don't, then you're going to incur what's called a LISA, L-E-S-A. That's life expectancy, excuse me, life expectancy set aside. So basically they would take money up front to cover the taxes and the insurance for the life of the loan. That's not always the case, but it's a protective layer, kind of protect you in all honesty. There's also PMI, which is private mortgage insurance, that protects the borrower and the lender. So in the event the lender closes shop or something to that effect, PMI will prevent you from going under with them. They'll be covered by that. And mortgage insurance is actually paid to FHA, so you'll be protected and your heirs, and you'll never own more than the home is worth. Right. So there's negative amortization and amortization. With a reverse mortgage, the loan balance increases over time because you're not making payments. But it's also compensated or counteracted with appreciation of the home. So as your loan balance goes up, your home value also goes up. So it kind of helps compensate for that. And then finally, you do not have to have heirs or a spouse to get a reverse mortgage. It could just be you. And if that happens, let's say you get a reverse mortgage and it's just yourself. Once you pass away, the bank will, they'll take your home, but you have nobody else to pass it to. If you have heirs, they can potentially, take the home over. There's rules with that. Next slide, please. All right. So, myth number one: people think that the lender is just going to take ownership of your home. Just like any other mortgage, you keep the deed and the title. Um, the You're still legal owner of the home, just like a traditional loan. The only time they would take the home is in the event you pass away, you can't make payments, or something to that effect, or if you can't make your tax or insurance payments either. So you're going to benefit from appreciation over time, like I said, to counteract the interest that's accrued, and that it's going to be dependent on their area because there's going to be some markets that houses appreciate less and some more. So that's something kind of like one of the variables you're not going to know. So again, the lender has a lien on the property, not ownership, just like a regular mortgage where you get a mortgage and a lien is put on the property. It's a traditional loan and it's secured by your equity. Um, so as long as you maintain the taxes and insurance, and if you're an association, so association dues, and they're paid up to date, the bank can't take your home. The only way they can is if you default on that, if you don't make your payments on tax insurance, or if the home is not maintained. So that's kind of the long and the short of that aspect. Even if your spouse is not on the loan, and this is one of the things that's changed in more recent times over the past 15 years with new regulation, even if your spouse is not on title or on the loan, the spouse can still keep the home. One of the reasons you don't want to have your spouses on there, let's say your spouse is 60 years old and you're 80, it goes off the younger of these spouses. So you would get less money because your spouse is on the loan. The 80-year-old gets more, frankly, because they have a shorter life expectancy. So it's a lower risk to the lender, and therefore they're going to give you more. Again, I know it sounds a little doom and gloom. It's just kind of the nature of the beast. We all have a life expectancy, hopefully 100 years old or more, if you want to live that long. Next slide, please. Myth number two, you cannot be forced out of your home. There's no monthly mortgage payments that you have to make. As long as you maintain the property, pay taxes and insurance, they cannot take your home legally, and you are protected. It must be your primary residence. It doesn't apply to second homes or investment properties. And you can't be forced to move if the terms are met. So if you fulfill everything, make your tax insurance, HOA dues, and the home is maintained, no matter what, no matter how, they can't take the home from you. And like I said, even if the lender closes shop, the loan will be transferred to a servicer and terms will never change. So just like a traditional loan, typically right after you close, especially these days, your home is sold to a servicer. There's two of the largest servicers in the country. Your terms never change. It's just where you make your payments to. In this case, you're not making payments typically, so it doesn't even matter. You'll get a letter as to where it's being serviced, and then kind of that's that. Next slide, please. Myth number three, heirs will lose the family home. That's not necessarily true. Heirs are given the opportunity to repay the loan and retain ownership of the home if they choose to do so. Or they could sell the property, keep the equity, or refinance. So the heirs could sell the property, they can keep any remaining equity after the loan is paid, or refinance into a traditional loan if they qualify. They can walk away. They're not personally liable for the debt whatsoever. So it's a non-recourse loan, which is a great sticking point there. Non-recourse, meaning they are not liable. And then finally, they can walk away if they're underwater. No matter what the value is when the home is sold, you can never owe more than it's worth. In fact, uh, the rule is you can never, let's say you owe 400,000 and the value is 200,000. It still doesn't matter. You can never owe more than 95% of the value of the home. So no matter what, you're still going to walk away with at least 5% equity when you sell that home after the borrower, let's say your parent, passes away. It's something people think as well. Is, just you're underwater. Oh no! Now you're going to have to come up with hundreds of thousands of dollars. That's not the case. There's a protective layer. Again, these are a lot of the things that have changed over time in the past 10 to 15 years that have made the reverse mortgage less risky. Next slide, please. Reverse mortgages are risky. We've been talking about risk. That's the major factor here. Now, in every mortgage, risk is everything. Banks try to mitigate risk with better qualifications or maybe lending less of a loan to value. So there's more equity in the home. So in the event they take the home, they have equity in there. So it's no riskier than a traditional mortgage, and I feel it's in fact less. And reason being, for a traditional loan, if you sell, if you miss 3 to 4 mortgage payments, you're foreclosed. They're taking the house regardless. Reverse mortgages do not require any payments. So once you're in the loan, they can't do anything about it. It's your home, and it's your loan. You can never more than the home is worth, which is due to the PMI protection. And heirs have 6 months to sell or refinance. Extensions are possible with extenuating circumstances such as pending probate, selling, refinancing, title issues, natural disasters. So I've seen anywhere from 6 to 18 months they'll give you to actually refinance or sell. They don't want to take the home, trust me, and they will work with you. So again, the banks are not there to take your home. They're trying to help you. Yes, they're making interest on it, but they're not going to actually try to take it away from you because there's a lot of you'll especially in this day and age with technology and social media. They don't want to have something over their shoulders that complaints, things like that, of taking advantage of elderly borrowers. Next slide, please. You could owe more than your home is worth. So like I said, you never can. FHA protects you from owing more. So at the time of death, I know I said 95%. If you were to pass away and your heirs take over the home, they can never owe more than 95% of the home. But the way that the loan is structured, and obviously it's going to be dependent on appreciation, the way that they structure the loan is that by the time you pass away, and I believe they use like 102 as like the time of death as the kind of the average lifespan, which is very high. You should never owe more than 80%. So even at the time of death, you should never owe more than 80% of the home. So typically your heirs will have 20% equity. Again, it depends on the market, how the housing market's doing, and all that stuff. So repayment is limited to the appraised value, not the loan balance. So regardless of the loan balance, if the value comes in at X, you only owe 95% of that. Heirs are not liable for shortfalls. Like I said, they don't have to come up with anything. And PMI protects you, as I explained earlier. So if the heirs decide to sell, they can never owe more than 95% of the current value, regardless of the loan balance. I've emphasized that, but these are very important factors to consider because that's, again, one of the things that people say is, hey, they're gonna, I'm gonna be underwater. Now what? You're protected no matter what. So let the value go down. It doesn't matter. You are protected. Next slide, please. Reverse mortgages lock you into your home. That's not true. There is no prepayment penalty. You can sell at any time. There's no early payment, anything of the sort. The loan is paid at closing, and you could use the proceeds to buy another, like I said, as a purchase HECM loan. You can get a new reverse mortgage if you want to downsize. So you can actually have a reverse mortgage on a large home. And let's say you want to downsize, you could pay off that one or sell that one, pay off the reverse, and then move to get into a smaller place and get another reverse mortgage. Put down 50% or whatever it is, 60%. And again, you have your home, you're not making any payments. Next slide, please. People think that it affects Social Security and Medicare. That's not necessarily the case. So the proceeds that you get are not counted as income. You're not being taxed on the money that you receive through the reverse mortgage. Your Social Security and Medicare stays unchanged. You don't have a reduction or a cut or a shave on it just because you're getting more would you consider income, but it's not income. It's just your equity being given to you from a bank. So these funds are not taxable. But in terms of Medicaid, that's something you want to check separately because there are little nuances. The one thing that I will say about reverse mortgages is that there's more of a gray area. There's no exact set guidelines with reverses. Every case, every person has a different kind of modus operandi, and everything goes into play. Every little factor will go into what you're eligible for and kind of the ins and the outs. But the basic stuff that I explained here, that's gonna be fixed no matter what. So with Medicaid, one quick thing: Medicaid's a need-based program with asset limits. So large lump sum withdrawals may affect eligibility if not managed properly. So that's where your financial advisor would come into play, or attorney, or whoever's going to be your kind of fiduciary. Next slide, please. People think you can outlive the reverse mortgage. That is not the case. There is no expiration date if the terms are met, no matter what. As long as you live in the home and meet the basic conditions, which is paying for taxes, insurance, and HOA dues, they can't take the home from you. So you'll continue to receive payments or have access to your line of credit while you live there. And then the built-in protection is FHA. They ensure that the loan is structured to last for the borrower's lifetime, assuming all obligations are met. And again, you cannot outlive the loan. They're designed specifically for longevity. So you can't outlive the loan as long as it remains your primary residence. Now, if you were to move into a assisted living, that's when the loan would come due and you'd have to work that out. If it's a short-term thing, maybe a hospital stay, again, these are things that you'd have to discuss with myself and the lender. But as long as you're not permanently leaving and going into, let's say, assisted living, where this is no longer your primary home, uh, they can't, call the loan on you. When I say call the loan, that means your loan is due. You have X amount of months to pay it off or refinance. Next slide. The loan terms change if lender changes. As I explained earlier, regardless of who services the loans, your terms are fixed at closing. The interest rate, loan amount, disbursement schedule, they are locked in. Nothing will change no matter what. Again, as long as you live up to your side, which is making payments on tax, insurance, and HOA dues. The servicer can't alter terms. No matter who services your loan, the terms remain the same. And this is the same for a traditional mortgage. If your loan is sold, on a Freddie Mac or Fannie Mae loan, the same thing. Your loans don't change. And this is what I tell people. No matter what, whoever is servicing your loan payment rate, term, loan amount, that stays the same. And your original protections remain, consumer protections, regardless of the servicer changes. And they can't change your contract without your consent. So the loan is a legal agreement, can't be modified without your signed authorization. And then finally, myth number 10. So people think that this is just for desperate homeowners. Now, it definitely has a place. The reverse mortgage is not for everybody, and that's why there's large, consultation involved to really do a deep dive on where you are, what your goals are, long-term, short-term, your family, your life, to determine if it's good for you. And if it is, great. If not, there may be other products. And we would never want to put you or your clients into a reverse mortgage if it's not, fit, because we're here to help, not to hurt. So it's used across many economic levels. They're not just for the rich or the poor. It really depends on your financial background and strategically to see if it's worth tapping into that equity or not. It's a good part of retirement strategy. A lot of financial planners are now incorporating reverse mortgages into retirement planning to supplement income and preserve investments. So instead of having to liquidate investments that are doing well, you can just get a reverse mortgage to make the payments for the mortgage while at the same time letting your investments grow if you're in like a good market. So that kind of protects you for that, and your financial advisor will probably be happy as well, so they can protect your liquid as well, or your retirement assets. It provides cash flow flexibility, so it offers a safety net and a buffer for unexpected expenses without dipping into retirement accounts or selling investments. So you could, like I said, take a monthly distribution, or you could take quarterly or lump sums, and this is just good to have for worst case scenario, for rainy days. That's why I always tell people, even with the traditional mortgage, you want to have money left over. You don't want to put all of your money into a home because you can't just get the equity out after it's in there. So I'd rather my clients put down less money so they have more money left over, and for you never know what could happen. Next slide. Just a couple more little here, little bullet points. So as expressed earlier, today's regulatory protections truly protect the borrower from getting them in, underwater, pun intended. So HUD counseling is required, and it's a lot. It's a lot of counseling. You have to have an independent counseling through a HUD-approved agency. It's mandatory. It ensures the borrower understands the product, the cost, alternatives. It's not a sales pitch. It's really an educational safeguard designed to protect seniors from making uninformed decisions. Financial assessment, they do a deep dive in your finances. If, for instance, let's say you're back on your taxes, that's when they're going to enforce the LISA, which is a life expectancy set aside, where they're going to take the duration of your life taxes and insurance up front to make sure that's paid. And then non-recourse, like I said, no matter what, you never owe more than the home is worth. You have a 3-day right to rescind or cancel a loan, which is on refinances, not purchases. So even after you close, you have 3 business days to cancel the file if you want to. And like I said, loan officers such as myself will discuss all the options to prevent steering, which is putting you into a loan that benefits them more than you. So next slide, only 2 more here. So the key takeaways: they're safer than ever. There's regulatory protections protect you or your client from getting into the loan if they're not meant for it. There's no email correspondence. Everything is physical. Everything is written down. The application is 100 something pages, but it's very clear, and that's why it's important to really do a dive with your consultant or your loan officer. Education is key, and they mandate that. It's very important, and it's a great retirement tool if it fits your criteria. And that is my little spiel. So a bonus here: anyone who attended. I'm going to give you a free consultation. You can reach out to me anytime. We'll set up a day and a time. I'm readily available to help you or your clients. We could do a conference call if it's for your clients or your family, if everyone wants to get on. And then in terms of the appraisal, which is required for the reverse mortgage, anyone who attended or referred, I will reimburse your appraisal at closing, technically free. And typically appraisals could be $750 to $1,000. So it's a nice little bargaining chip there. And that is it. My contact information is right here, and you can reach out to me on email, call. I'm on Instagram, Facebook. Again, I'm readily available. I make it a point to be available for my clients. It's important to have open communication. A mortgage is the most biggest investment of your life, and I want everyone to feel comfortable when they work with me, so that they don't have any stone unturned. So that is that with the reverse mortgage. And just to emphasize once again, I'm going to be able to provide you these slides with also explanation for each slide if you'd like. So I know I talked a little quick. If there's anything you missed, I'll have this, put on a plate on a nice platter for you. So you'll have it to save for, again, yourself or your clients, or a little cheat sheet if you need to go over this with your clients, if you're like a financial advisor or something to that effect. Or if you have a family member that's interested, you'll have facts and information about them, kind of rebut them. So if they say, "Hey, I heard that they're going to take your house," no, they won't. And now you have the reasons why.
Great. Well, thank you, Michael. That was a lot of information because it is a complex topic, but I think you did a
Great.
great job debunking the myths.
Thank you.
Anybody who wants copies of the slides, I think that's great. Michael's offering those. So here's his email. You can also, of course, contact me if you need to reach him, but definitely take advantage of the free offer. That's a great thing. I'm going to do my presentation now on Medicaid, and then we're going to follow that up with an open Q&A. So at that point, I'll probably turn the recording off and we'll do the Q&A. And then if people want to ask questions without, being dealing with the recording, then that'll be great. So again, thank you for coming. A little quick disclaimer: the contents of this presentation, as well as any answers discussed during the Q&A session, are provided to you by way of general legal information only, should not be construed as legal advice. If you have a specific legal situation, you should consult with a licensed attorney. So I'm Leslie Sultan. I'm an estate planning attorney. As you can see from my picture, I'm also a mom with 2 kids. I founded my law business in 2010, and I'm now partners of Sultan and San Martino and Sultan Law Group. And not only am I an attorney, but I'm also a daughter to a mother who needed a Medicaid trust. So I've been there. I know what's involved, unfortunately. So let's go through the common Medicaid myths. Hopefully some of these will resonate with you because there's some that you've heard or you've been thinking about. So I'm going to go through the list and then I'm going to break those down a little bit later. So one common one is I have too many assets, or I own a house, so I'll never qualify. Number 2 is my income is too high, I won't qualify. Number 3, I'm not old enough to qualify. And these are not in any particular order, by the way. Number 4, I have to spend all my money before I receive Medicaid. Number 5, Medicaid is only for people who live in poverty. More common myths: I lose control of my assets when I put them into a trust. I have to spend all my money before I receive Medicaid. Number 8, Medicare is the same as Medicaid. Number 9, Medicaid aids are not as good as private pay aids. And number 10 is Medicaid will take my house and or freeze my bank accounts. So we're going to talk about Medicaid trusts, which are the main legal vehicle for people to protect their assets and qualify for Medicaid. So a lot of people have heard of a living trust, a revocable trust, and the question is, does that offer asset protection? In other words, if I go on Medicaid, is Medicaid going to take my house later? Medicaid does have this program called estate recovery. So anything that passes through your estate, Medicaid gets, first dibs at it. So a revocable trust is a way to avoid probate. It's not always a way to protect your assets. So a revocable trust, if you have one, is a powerful estate planning tool. It's used to avoid probate. It protects your privacy, unlike a will that has to go through probate court. And it does the same thing as a will. It gives, you list your beneficiaries and can minimize estate tax. But when the grantor has a revocable trust, they're in control of the assets. They're also the trustee. So if the grantor is in control of their assets, they're not going to get the asset protection that we need for Medicaid planning. That only comes in when there's a third party who is managing the trust, then it receives the Medicaid benefits. Quick background on what is Medicaid. It's a joint federal state program administered by local governments. It's a means-tested, needs-based program with limitations on income and resources. The federal government sets the guidelines, and then each state designs its programs. If you're in New York, which hopefully all of you are, we have one of the best Medicaid programs. So if you're here, hopefully you're going to be able to find ways to take advantage of that. The programs do vary greatly from state to state, and it pays for what we call long-term care, not health insurance. So how does one qualify for Medicaid long-term care benefits? So you have to either be 65 years old, blind, or disabled. So again, the myth, you don't have to be older if you are blind or disabled. You do have to be a resident of New York, and you have to be unable to perform at least 2 activities of daily living. So bathing, toileting, grooming, dressing, eating, ambulating, transferring. So as long as you have 2 of those on the list, you're going to be able to qualify. Now the income is you do have, or the assets, you have to have less than 32,000 and change in countable resources. So the list of countable resources is cash, stocks, treasuries, CDs, life insurance, annuities, houses, etc. So those are considered available assets when they're owned individually or jointly. But if you create a Medicaid trust and you transfer those assets out of your name and into the trust, it can protect that asset and allow people to qualify for Medicaid. And when I'm referring to Medicaid, there's 2 types. There's nursing home, and then there's in-home, where the aides come into your home and you don't have to leave. So with a Medicaid trust, just as a general overview, the grantor can always change the beneficiaries. You could say, I leave everything to my daughter, but I'm disinheriting my son. You can always change that if you make up with your son and add him back in. You can change the trustees. So I'm going to make my daughter my trustee. All of a sudden, daughter's doing a lot of traveling on safari that, she doesn't have the money to pay for it. You assume she's misusing her role. You can remove her as the trustee. The main trick with the Medicaid trust is that grantor, the person setting up the trust, is only entitled to the income, not the principal. The principal has to stay in there. And you can't change the corpus of the trust, so you're not allowed to move things in and out. You can sell the house in the trust and buy another house, but you don't want to put the house in the trust and then take it out and put it back in your name. All right, so I mentioned there's home care Medicaid. This is the ideal, right? So you get to stay in your home, and the aides come to your home. Right now for New York, there is no look back. This is really important. There's something called a look back period, which I'll discuss in a minute. So as long as you apply, today you move all your assets to the trust. Today, tomorrow you apply, you'll get qualified for Medicaid. You don't have to wait what's called during the penalty period. The bad news is that they've been talking since 2020 about implementing a 2.5-year look back period. So that's 30 months. That would not be great because it means you move your assets and then you shouldn't apply for 2.5 years. So that's not an ideal situation if you need the care. So the recommendation is you do the planning and application before you need the care. And that way, if the look back goes into effect, you're already grandfathered in because you already did the application. If you don't need the hours, you just don't take any hours of care. You can have some income up to it's around 1,800 in income every month, and you can keep 30,000 or change in your name, 32,396. So you can have a bank account that you still control and you use to pay your bills as long as the bigger savings, the house, etc., are moved into the trust. So, you really want to start planning ahead of time before you need the care because of these look back periods. The other type of Medicaid long-term care is for nursing homes. This is sort of the end of the road. Most likely, we don't want to go into a nursing home if we don't need to. More importantly, there's a 5-year look back. So if you do planning today and you need to go into a nursing home tomorrow, you're still going to be required to spend the money until it's gone if it's during that 5-year period. But ideally, you would plan now, not need the care for 5 years. If on year 6 you need to go into a nursing home, it's fully covered and your assets are protected. Again, with both these scenarios, you're entitled to some income, very little, and the 32,000 in assets. All right, so we talked about all of those points. I just want to kind of briefly go over probate because sometimes people say, oh, well, I have a will. Aren't I taken care of? No. So a will has to go through probate. I just like to make sure people understand what probate is. Probate is the process to transfer the assets to the heir through the courts. And this is required with a will and without a will. And here's the trick, guys, and this is the part that most people don't realize. The whole court system, the surrogate court probate system, is designed for creditors. We want creditors to lend to people, and so we have to give creditors a way to get their money back if someone dies. The children aren't going to have to pay the debt, but the estate has to pay the debt. So anything that goes into the estate, the creditors get first dibs. And so that's why Medicaid puts sometimes a lien on the house. They get to go after the house. Then when the family sells the house, they have to pay back Medicaid for the 2 years that mom was in the nursing home at $20,000 a month. So that can get really costly. Sometimes you can negotiate the debt, but at the end of the day, the children cannot receive the money until all the creditors are paid first. So again, if I have a will, can I avoid probate? No. A will has to be verified and acknowledged by a judge. Your children don't get to take it to the bank and say, give me my money. The bank says, take it to the court, then come back with some legal documents that prove that this will is valid. If you have a house, no assets can be transferred, bank accounts get frozen. If you have rental income, no income can be collected until all of that probate process is completed. In some states like New Jersey, probate takes a couple weeks. Unfortunately, in New York, for whatever reason, it takes months. Unfortunately, depending on which county, it can take up to a year, even a simple estate. So we try to encourage clients to avoid the courts as much as possible, avoid probate. The best way to do that is through a trust, either revocable or irrevocable. You can also name beneficiaries wherever possible. Obviously, there's concerns around that, but that's for another day. But then again, if you do have a will, once all the will is probated, an administrator or executor is appointed. That will allow the executor to sell the house, pay off any debts, etc. So again, all creditors get paid before the terms of the will can be enforced. How do you avoid probate? You create a trust, and then you have the trust own the assets. So if you have a house, the title, your name comes off the deed, and it goes into the name of the trust. So the Leslie Sultan on the house now becomes the Leslie Sultan Trust owns the house. I'm the trustee because I have a revocable trust, or I would have my friend or family member be the trustee if I'm doing the irrevocable Medicaid trust. The trustee maintains control over the assets during the lifetime of the grantor, the person putting the assets in. And then the control automatically transfers to the named successor trustee who has instructions to distribute it to the beneficiaries, just like a will, just like you've seen on TV. but without any of the court process. So I don't need a judge to tell the trustee what to do. It's all in that legal document. They don't need any legal authority. If there's rental income and the trust owns the house, they just go straight to the tenant and collect the rent, because the only thing that changed is the trustee. This also goes into effect when someone becomes incapacitated. So I'm still alive, but I can no longer manage my money. I need assistance. Now my successor trustee can take over. So I know this again was a lot of information. We've rushed through some things, but again, just to review these myths, there's not an issue of having too many assets to qualify, as long as you move the assets into the trust. If income is too high, there may be something that's called a pooled trust that needs to be set up. This is a third-party agency that everybody in Medicaid has to contribute that excess income. The excess over 1,800 goes into that pooled trust, and then it pays for your expenses. So if you think your income is too high, you're just going to want to consult with an attorney to make sure that you can figure out the best solution. Does it make sense for you? I'm not old enough to qualify. We looked at that. As long as you have a disability and those two, at least two of the daily living restrictions, you qualify. You don't have to spend all your money as long as you put it in the trust. It's not just for people who live in poverty. We've helped many millionaires qualify for Medicaid, believe it or not. So it's very possible. I lose control of my assets when I put them in a trust? No, because although somebody else is the trustee to manage them, you still have the control to remove them and the authority to tell them what to do with the assets. You don't have to spend all your money. You just have to move it to the trust. It's not the same as Medicare. Medicare is covering health care and some long-term care, 100 days, for example, if you went into a nursing home. Medicaid is the long-term care beyond those 100 days. Now, Medicaid aids are as good as the private aids because they're all used by the same agency. So Fidelis might use an agency, and it's the same private pay agency. They're all the same aids. Of course, there are some private companies that don't accept Medicaid aids, but it's very rare. And as long as Medicaid will not be able to freeze your accounts or take your house if it's not in your name. So that's the quick and short version of debunking the Medicaid myths. I'll open this up for Q&A, but also just like Michael, I'm offering a discount. Anybody who wants to use our services, you attended this webinar, you'll get $500 off of a trust plan. So please take us up on this offer. We don't offer this regularly, but we do appreciate that you took the time to come and listen to these, and you save us time in having to explain it over and over again during individual consults. So we do value that you took the time here today. So just mention that you attended the Medicaid Myth webinar, and we will give you a discount on your trust plan. This is my contact information. We have offices in throughout Long Island. I mostly handle the Garden City office. We also have Lindenhurst and Wantagh, and Queens and Brooklyn. So we do also do virtual. So if you know someone who's, sort of homebound, we do make home visits. So we try our best to accommodate people because it's, sort of the nature of this business. So hopefully I've answered your questions. I'm going to stop the recording now and we will take questions. And thank you again, everybody, for your attendance.